US-China trade tensions remain the market driver, and this has seen the US dollar stronger against most of its G10 peers this week, except the safe haven Japanese yen and Swiss franc. But the real movers were closer to home. We had RBA and RBNZ announcements this week, and the RBNZ certainly surprised the market and had us seen the Kiwi dollar the weakest of the G10 currencies this week, down 2% to be at 66 cents, a low back to March 2016. The Reserve Bank of New Zealand kept rates on hold at 1.75%, as unanimously expected, but they substantially downgraded their GDP forecasts. They talked about downside risks to economic growth and consequently pushed out the date when they expect to start lifting interest rates, saying the bank expects to keep its cash rate at 1.75 through 2019 and into 2020. New RBNZ Governor Orr said the RBNZ is in watch, worry and wait mode, but he could well have been speaking for many central bankers around the world. In particular, there remains a wide range of expectations on how the US-China trade war will play out. This week we saw the latest salvo as China imposed 25% tariffs on $16 billion of US energy and vehicle imports, justifying this as simply matching the US measures. Well, we now await the next round of US tariffs. Despite this increase in trade tensions, global equities have put in a solid week as current reporting season has been okay. Closer to home, we also have heard repeatedly from the RBA this week, who might also be classified as in watch and wait mode, although perhaps with a little less worry. On Tuesday, the RBA board kept the cash rate unchanged for a record 2 years, although there are a number of changes and additions to their statement following the meeting. Notably, the unemployment rate is expected to fall over the next couple of years to around 5%, although given the level of underemployment, the changes in demographics and technology, it seems likely to us the full employment rate could be lower than this, and even with this new lower 5% forecast, it seems a big call to expect a sustained upward pressure on wages growth. Of course, the other domestic factors of housing and wealth effects, Chinese growth slowing, and a subdued inflation are also adding to our long-held view that rates will remain on hold through 2018 and 2019. Despite last week's interest rate rise by the Bank of England, sterling has also been a notable underperformer this week and falling to one-year lows versus the US dollar. This is as the complexities and realities of Brexit mount while the deadline draws ever closer. Data in the weeks ahead is unlikely to change the impression of soggy activity conditions impacted by this uncertainty. Of course, trade and US-China relations will continue to dominate headlines, but next week we have a big domestic calendar to focus on. We have updates on consumer and business confidence, followed by wages and employment data, which, as we have discussed, is shaping up as the critical in the current policy debate. While there are numerous events to navigate, it seems it would take a major surprise to break the Australian dollar out of its current 73 to 75 cents range that has held since June. We'll be back to talk to you next week.